Hello, my name is Bryan Minogue, and in this video, we're going to do a brief blind taste test of 5 investment portfolios. We'll look at some summary statistics of 5 portfolios over the last 30 plus years, and then reveal what those underlying portfolios are. Ultimately, I hope this is an interesting exercise for you, makes you a bit more curious about investment portfolio construction, and also dispels a few myths. Let's get to it. Here's a very high-level summary of 5 investment portfolios from 1992 through September 24th, 2025. We're looking at the annualized returns of each portfolio, their volatility measured by standard deviation, and their worst drawdown. Looking at these numbers, which portfolio is most attractive to you? And if you need more time, please feel free to pause the video. Next, I'll reveal these mystery portfolios and walk through some additional metrics and graphics. So here's the same chart with the portfolio names revealed. Portfolio 1 is a global stock market, your traditional accumulator portfolio, invested in 100% stocks. Portfolio 2 is a global stock market portfolio with an additional levered exposure to 10% in gold and 10% in managed futures. Portfolio 3 is a 60-40 mix of stocks and bonds, your traditional retirement portfolio. Portfolio 4 is that same 60-40 portfolio with an additional levered exposure to 10% gold and 10% managed futures. And lastly, Portfolio 5 is a risk parity style portfolio levered 150%. Under the hood, this portfolio is roughly 45% stocks, 82.5% treasury bonds, 11.25% in gold, and 11.25% in managed futures. If you would like to take a closer look at these portfolios and statistics, please check out the link in the video description below. I think the vast majority of you will be surprised to learn that you likely preferred a levered portfolio compared to the unlevered portfolios. And this is a rational choice. The levered portfolios delivered better returns with less risk, as measured by both volatility and maximum drawdown, compared to their unlevered counterparts. We've had drilled into our heads that the use of leverage is a sure path to ruin, and leverage only has a place in a gambler's portfolio, not in a prudent long-term investor's portfolio. However, what's important here is how leverage is being used. In this example, in portfolios 2 and 4, we're using a modest amount of leverage on top of the traditional portfolios to invest in diversifying exposures, gold and managed futures. Historically, these assets have been uncorrelated to both stocks and bonds and have delivered their best relative returns when stocks and bonds are suffering. And the most levered portfolio, the risk parity 150%, is taking a highly diversified, relatively low risk portfolio and levering that up. The unlevered risk parity allocation has historically been about half as risky as a 60-40 portfolio and a third as risky as a 100% stock portfolio. So even when you apply 50% leverage and multiply the risk by 1.5, this portfolio is still less risky than both the 60-40 and global stock market portfolios. Put another way, you'd need to lever up the risk parity portfolio 3 times to get near the historical risk of 100% stocks. This last levered portfolio is an example of modern portfolio theory, which was introduced in 1958. This theory states that an investor should take the optimal mix of assets, or the mix that gives you the highest return relative to your risk, and if you desire a higher return, apply leverage to that diversified portfolio instead of offloading your diversifiers and concentrating into the highest expected returning asset or stocks. This theory is often accompanied by a graph that looks like this, which shows how applying leverage to a diversified portfolio is expected to provide a better portfolio experience than offloading your diversifiers and concentrating into the highest expected returning asset, again, stocks. If we were to plot these 5 portfolios on this graph, you would see the theory bear out. In this graph, you can see the levered diversified portfolio provides the highest return with the least risk. And you can also see how using leverage to invest in diversifiers like gold and managed futures has historically provided better returns with far less or similar risk. To underscore the idea that leverage does not necessarily imply greater risk, here's a look at the historical drawdowns of the unlevered portfolios versus the levered portfolios. First, here's a comparison of the global stock market in blue to the global stock market plus gold and managed futures in red. The levered portfolios suffered less severe drawdowns and recovered more quickly during the worst periods for stocks. The same story plays out when comparing the 60/40 portfolio in yellow with the 60/40 plus gold and managed futures portfolio in green. And lastly, we can see how the most levered portfolio, seen here in purple, suffered the least severe drawdowns compared to the other four portfolios. So while I very much understand that for most, the primary reaction to the idea of leverage is to run, I hope this video communicates the importance of first questioning what leverage is being applied to. And again, please see the link in the video description to explore the data for yourself. Yes, all else equal, a 2 or 3 times levered stock index is going to be more risky than an unlevered stock index. But as we've just seen, a levered diversified portfolio can still be far less risky than an unlevered stock portfolio or even an unlevered 60/40 portfolio. The data in this video is a sort of proof of the 1958 theory. And while this theory has been employed by hedge funds and institutions for decades, it's been beyond the reach of the individual investor. But evolutions in the ETF landscape in the last decade now allow virtually any investor to employ this strategy through ETFs on major brokerage platforms. So now you can decide whether you'd like to take the traditional approach of combining stocks and bonds to build your portfolio, or apply leverage to a far more diversified portfolio as theory would suggest. Thanks very much for watching. Please check out the links in the video description to learn more.